If you're still looking at line charts to make money moves, I need you to put the phone down and listen for the next 5 minutes. Because a line chart is like reading the last sentence of a text thread and thinking you know the whole conversation. Today, I'm putting you on game. Candlestick charts, moving averages, and the exact hours of the day when the market gets wild, so you stop trading blind.
Here's a line chart. Clean, simple, and honestly, it's doing you dirty. A line chart shows you one thing, usually the closing price. That's it. One data point per day. But check this. Let's say a stock closed at $50 yesterday and $51 today. The line chart says, nice little move up. Calm. Peaceful. What it's not telling you, that stock might have dropped to 44 at lunchtime, scared everybody out of their position, then ripped right back up before the close. If you held through that, your stomach was in your shoes at noon. The line chart? It never even knew it happened. That's the problem. Line charts show you the result. They hide the battle. Same day, two totally different stories. One candlestick gives you 4 pieces of information. Open, where the price started. Close, where it ended. High, the most buyers were willing to pay. Low, the cheapest sellers let it go. The thick part, the body, that's open to close. The skinny lines, the wicks, that's how far price traveled before getting rejected. Green candle, buyers won that round. Red candle, sellers took it. And here's where it gets powerful. Candles show you emotion. Long wick on the bottom, sellers tried to tank it, and buyers said not today. That's strength. Big red body closing at the lows, that's panic, people running for the exits. Tiny little candle after a big run-up, that's hesitation, the market catching its breath. A line chart can't tell you any of that. It's the difference between reading the box score and actually watching the game. Candles tell you what's happening right now, but how do you know the bigger trend? That's where moving averages come in. A moving average takes the average closing price over the last X days and draws it as a line. It smooths out the daily noise so you can see the actual direction. The 3 everybody watches, the 20-day short-term mood, the 50-day, the medium-term trend, and the 200-day, the big picture, the line institutions watch. Price above the 200-day and it's sloping up? That stock is generally in an uptrend. Price keeps bouncing off the 50-day like a trampoline. Traders are using it as support. Price falls below the 200-day? That's the market telling you something changed. Moving averages won't predict the future. Nothing does. But they keep you from fighting the trend, and fighting the trend is how accounts get blown up. Here's the gem that saves beginners real pain. The market does not move the same all day. The open? Pure chaos. Lunch? Dead. Full of fake-offs. But the power hour, that last hour before the bell, that's when the big money moves. So if you're new, let the open settle. Watch it. Don't donate to it.
So here's the play. Next time you open a chart, don't just look at where the prices are. Look at how it got there. But stop looking at the lines. Start reading the battle. I'm Charlie Blue. See you in the green.